To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Friends, let's now have a look at the RTP of accounting paper for May 23 examination. First, we'll look at the list of applicable amendments. Now, most of these are old amendments, so which has already been covered as a part of our lectures. And if at all you are using older books, okay, then these amendments become important. Now, one of them, which is a recent one, is that related to a small company. Okay, so in the definition of a small company, I don't know what they want. Every 6 months there is an amendment. Okay, so many amendments that you will also lose a track of what is the amendment. So now here, as far as the rules are concerned, where the limits are prescribed, it says paid up capital and turnover of the small company shall not exceed 4 crore and 40 crores respectively. So 4 crore and 40 crore, this is what is relevant for your May 23 examination, right? Then Schedule 3 Division 1 amendment, this was done way back in September 21 edition. It is already updated, and this was done in March 21. So this you don't need to worry. Then classification of non-company entities for accounting standards. Again, this is an older amendment. We already have a detailed video on that. You can have a look at it. You can just search for applicability of accounting standards Indigo, and the entire applicability and non-applicability is covered in that video. Very short video that will help you understand. Right. Then they have said that September 21 edition of the study material is applicable. See, most of the cases for accounting, it should not be a challenge. Even if you have an older material, just take care of those debenture related amendments and amendments to Schedule 3. That should be sufficient. And Ind AS is not applicable. We know it. Right. Now, having understood that, let's move on to the core part where we will see the questions. The first one is preparation of balance sheet of a company. So they have given us equity capital. I keep on telling, whenever you are reading the trial balance, whenever there is a balance sheet related question, ignore the amounts, because amounts you can copy and you can put it in the balance sheet format. So what you need to understand is what is given: equity share capital face value 100, calls in arrears, this we will reduce from the capital value. Land and building, this is a part of your PPE, plant and machinery, furniture, okay, general reserve, loan from state finance corporation, inventory, raw material, finished goods. Provision for taxation, credit side balance, trade receivable, advances, P&L credit balance, cash in hand, cash at bank, unsecured loan long term, trade payables 250. All of the information has been given, and then additional information, 2500 equity shares were issued for consideration other than cash. This you will disclose in the notes to accounts. Debtors of 65,000 are due for more than 6 months, separately you have to present. Cost of assets 750, 875, 78125. This and whatever is the difference between cost and the carrying amount given here, that will be your accumulated depreciation. Then balance of 1,875,000 in the loan account with State Finance Corporation is inclusive of 9,375 of interest accrued but not due. The loan is secured by hypothecation of plant and machinery. So one disclosure is for your security that you have given. Second is this 9,375 is your current liability that you will disclose separately. Balance 2,500 with Global Bank is not a scheduled bank, separately you have to disclose. That's it, nothing else, right? So quickly, if I show you the solution: share capital, reserves and surplus, long-term borrowings, trade payables, other current liability, short-term provision, this is taxation, PPE, inventory, trade receivable, cash, and short-term loans and advances. Now this is the format part of it, right? You would already be knowing the format. Now coming to the notes to accounts, how much is paid up minus calls in arrears, you will get the value. Then general reserve balance and surplus in P&L, you can take it from the question. So here if you come back and see, general reserve 262 and P&L balance 108,375, that is what is being used here. Then long term borrowings, secured term loan 9,375 is excluded and shown as a liability here, other current liabilities. Then you have to mention secured by hypothecation and then unsecured loan. Provision for taxation, yes. Then PPE, gross value minus depreciation. Inventories, breakup of raw material and finished goods. Trade receivables, outstanding for a period exceeding 6 months, others. Cash at bank with scheduled banks with others. That's it, right? So this generally it's more for practice purpose, for you to understand how to present the balance sheet. Okay, unless you're very lucky, I don't think you'll get a straight 10-mark question out of this, right? Now in examination, what you need to remember is when you have a P&L and balance sheet related question, this part of the balance sheet 1, 2, 3, 4, 5, 6 items here and 1, 2, 3, 4, 5, 6 items here, this would be roughly about 4 to 5 marks. Okay, and notes to account, each note 1, 2, 3, 4, 5, 6, 7, 8, 9. There are 9 notes. Some notes may carry half mark, for example, trade receivables, or for example, provisions, which has just one line item. PPE may carry 1 mark. So, you will also get marks for notes to account. So, whenever you are preparing balance sheet, please ensure you also prepare the notes to account with whatever information that is available, right? It's an easy 4 to 5 mark score which you can get. Then next one, Omega Limited provides following information as on 31st of March: authorized capital, preference shares, equity shares, issued and subscribed capital, preference shares, equity shares, share suspense account, reserves and surplus details have been given. Capital reserve 2,50,000 is revaluation reserve. Then securities premium, secured loan 15%, debentures, unsecured public deposit, cash credit, current liabilities, trade payable, asset, investment, P&L, debit balance. Share suspense account represents application money received on shares, the allotment of which is not yet made. You are required to compute the effective capital as per the provisions of Schedule 5 if it is non-investment company. Would your answer differ if it is an investment company? So now here, simple, these kind of questions we have done it in the class as well, right? If it is an investment company, you will not exclude the investments. If it is a non-investment company, you will exclude the investment. So if you look at the solution, you will take the paid up capital of preference shares, you will take the paid up capital of equity, right? Then the capital reserves, security premium. Now capital reserves, if you go back to the question, capital reserve is 438,750. 250 is on revaluation. So this 250 you will reduce and only show the balance part which is not on account of revaluation, right? Then you have securities premium, then you have debentures, unsecured loan. Now cash credit is current liability, it is not a part of your capital employed. So this you will not consider. Trade payables will not consider, and P&L debit balance you will reduce, right? So P&L debit balance, whatever is there, this you will reduce. Investment in shares, if it is non-investment, then this also you will reduce, right? So this whatever is the investment in shares, that will also be reduced. So total of your capital reserves, securities premium, debentures, public deposits minus investments and P&L debit balance will give you the effective capital, right? A simple one, a standard question actually. Then following is the balance sheet of Fox Limited. You are required to prepare cash flow statement using indirect method. So what they have given? They have given the balance sheet. So share capital is there. Now whenever there is a cash flow related question, amounts become important. So year 20, year 21, it is an increase. Reserves and surplus, also there is a change. Trade payables, okay, this will go to working capital. Short term provision is for taxation, you will take it separately. Then non-current assets, also there is a movement. Current assets, this is working capital change, this is also working capital change. Cash and cash equivalents is your reconciling item. Notes, 2 lakhs has become 410, so there is an inflow of 210 here. 1 lakh has become 150, so there is an inflow of 50 here. This is from your financing activity. Reserves and surplus, surplus in the statement of P&L at the beginning of the year 25,000, profit for the year 20,000, dividend 10,000, surplus at the end 35,000. Now this 20,000 is your profit after tax, okay, and dividend paid during the year 10,000. This information was not needed because it can be made, inferred from here. Depreciation charges during the year is 40,000. This is a non-cash item you will add back. Now, for us to start, profit for the year, profit after tax 20,000 is given, and provision for taxation 8,000 is given. Now, what you can assume is this 5,000 of opening provision is paid in the current period, because they have not given other advances, and 8,000 is the provision for current year, right? So that is one thing you can do, assume, and you can solve the question, right? So let's see what they have given us as the solution. So they have taken net profit 35,000 less 25,000. That's not the right way to start actually, because they have given directly the profit for the year. So what you will do is you will take profit 20,000, add back provision for tax 8,000, so you will have 28,000. So that is how you arrive at this 28,000, right? Then of course depreciation, non-cash item you will add back. Then working capital changes. Now for this I keep on telling that if it is an asset, do opening minus closing. So if you do opening minus closing, 50 to 120, opening minus closing minus 70. So if you see here minus 70, that will help you to remember. And if it is a liability, you will do closing minus opening. Then tax paid, as I told you, assumption that 5,000 has been paid. Okay, so provision for last year considered to be paid in the current year. That gives you the cash flow from operating activities. Then coming to investment activities, 180 to 350. 180 to 350, this is an increase of 170, and there is also depreciation. So what you can do is, you can prepare a T-shaped balance sheet. 180 opening balance, closing balance is 350. So this is balance brought down, this is balance carried down, 350, and there is a depreciation. Depreciation is credited how much? 40,000. So 40,000. So 390 minus 180, purchases would be the balancing figure. 390 minus 180, 210,000 or 2,10,000, right. So that is the purchase of plant and machinery. You have to prepare a working note. You can prepare in a statement. I prefer a ledger format because that is easier to understand. Then issue of shares for cash, issue of preference shares for cash, that is we have already discussed it. Dividend paid is a outflow, and that gives you the net increase, and you can do the reconciliation of beginning and the closing balance. Very, very simple question, again, nothing complicated. The next one, profit or loss prior to incorporation. Profit or loss prior to incorporation. Messrs. New Ventures, who was carrying on business from 1st of June, gets itself incorporated as a company on 1st of October. Now, generally we assume it is 1st of April, but here it says business was being carried from 1st of June and company was incorporated on 1st of October. The first accounts are drawn up to 31st of March. So for 31st of March, you have prepared the accounts, right? Now, normally what we assume, total period is 12 months. Here, June to October, June, July, August, September, 4 months, October, November, December, January, February, March, 6 months. So 4 months and 6 months is the pre and post incorporation period. The first accounts are drawn up to 31st of March, gross profit is 120. Following information is given: general expense 24,000, director fee 24,000 per annum. Now, how much is this for? You have to pay only for 6 months. Corporation expenses, rent up to 31st December was 6,000, after which it was increased to 8,000. So, pre-incorporation 6,000 into 4, post-incorporation 6,000 into, when did they incorporate? October. So, October, November, December, 3 months into 3, then it is 8,000 into 3, specific calculation you can do. Salary of the manager who upon the incorporation of the company was made a director is 12,000 per annum. His remuneration as director is included in the above figure of fees to the director. So, salary of the manager is 12,000 per annum. So, for the pre-incorporation period it is 12,000. His remuneration as director is included in the above figure of fees to the director. So, whatever is remuneration being paid as director, that is included as a part of this 24,000. Advertisement expenses 5,000 pertains to the incorporate company, purely post incorporation. Bad debts 4,000. Now, this we have to split in the sales ratio. Give the statement showing pre and post incorporation profit. Net sales was 20 lakhs, the monthly average of which for the first 4 months is 1/2 of that of the remaining period. The company earned a uniform profit, interest and tax may be ignored. So, now here the challenge is to calculate the pre and post sales ratio. What is the question says? Now, here the monthly average of which for the first 4 months is 1/2. It is not 1.5. Okay, it's 1/2. So, that is actually half of that of the remaining period. So, remaining period, if it is 1, for the first 4 months it is half. So, for example, if first 4 month is what? June, July, August, September. June to September, if it is, let us say X, okay, then October till March, it is 2X. Now, X is for how many months? 4 months. This is for how many months? 6 months. So, pre-incorporation 4X, post-incorporation 12X. The ratio can be 4:12, or that is 1:3, right? Then, apart from that, balance expenses you have to split on the basis of time ratio wherever they have mentioned. Then Rent up to 31st December was 6,000 per annum. Oh, so I think I took here 6,000 per month. So it is not 6,000 per month, it is 6,000 per annum. Such mistakes can happen. Okay. So it is 6,000 by 12, it is actually 500. So this is 500. This is 500. And after that, it has become how much? 8,000 per annum. So 8,000 per annum means 8,000 divided by 12, you get 666 per month. So you have to take 666.6 into 3 months, right? And apart from that, is there anything else? No, we have calculated the time ratio. Director fee is 24,000, this is for 6 months. Manager 12,000 per annum, this is for 4 months, okay? So, and because this remuneration is already included here, another remuneration is not needed. Now, let's have a look at the solution. Gross profit sales ratio we have already calculated 1:3. So, in the ratio 1:3, 30,000 and 90,000, because the question mentions gross profit is 1,20,000. So, 1,20,000 in the ratio of 1:3, this is 30,000, this is 90,000. Okay. Then general expenses time ratio. So, general expenses of 24,000 in the basis of time ratio. Time ratio we have calculated 4:6, that is 2:3. So, out of 24,000 by 5, if I do, I get 24,000. If I do it by 5, I get 5 4s are 25, it's 4,800. So, for 2 it is 9,600 and for 3 it is balance 14,400. Director fees for half year. So, director fees for half year 24,000 per annum, 12,000 is half year fee. Incorporation expenses is always post incorporation. Rent. So, rent if you see 5,000 into 4 2,000, 5,000 into 3 1,500 and this is 2,000. So, 2,000 and 3,500, right. Then manager salary 4,000 for 4 months. Advertisement expenses is always post, is given to be post. Back dates in the ratio of sales ratio, that is all you have to calculate, right. They have taken 100 and calculated the ratio, we have taken x and calculated the ratio, it is the same thing. Rent we have already done the detailed calculation. Time ratio also we have already done the detailed calculation. Now, one thing where you can get confused or sometimes you assume is here it is not starting of the period, it is not a full 12-month period, it is only a 10-month period, right. So, let us go to the next one. Accounting for bonus issue, pretty simple. Following items appear in TB of Satish, 9,000 equity shares 100 each, capital reserves including 8,000 being profit on sale of plant, securities premium 80,000, capital redemption reserve 60,000, general reserve 210, P&L credit balance 130. The company decided to issue bonus shares to equity shareholders at the rate of 1 for every 3. So, you have 9,000, so now you will issue 3,000 bonus shares. Company decided that there should be minimum reduction in free reserves, means in general reserve and P&L you will have the minimum reduction. Pass necessary journal entries in the books of Satish Limited. So, you just have to pass the entries. 3,000 into 100, you need 3 lakhs and you will touch general reserve and P&L towards the end, right. How do we do it? 3 lakhs is what you need, so you will credit that to bonus account. Then out of the question, whatever has been given, first, can we use securities capital reserve to the extent it is realized in cash 80,000, you can use this in your bonus issue. Then securities premium, yes, you can use. Capital redemption reserve also you can use. So, 80 plus 80 160 plus 60 220 and the balance 80,000 you will take it from general reserve, okay. Generally you would use general reserve first and then the P&L, because P&L is more free, because to transfer from general reserve to P&L for dividend, it is again a lengthy exercise, right. Issue of rights shares, it's a simple direct question, I will not break my head onto it, you can do it on your own. Then redemption of preference shares, one area where students find a lot of difficulty in. The board of directors of a company decided to issue minimum number of equity shares of ₹9 to redeem 250 preference shares. So, 2,50,000 is the face value of preference shares. The maximum amount of divisible profits available for redemption is 150. Now, when you redeem 2,50,000 of preference shares, you have to transfer 2,50,000 from reserves to the CRR, or you have to make a fresh issue. 150 is available for free reserves. Calculate the number of shares to be issued by the company to ensure that the provisions of section 55 are not violated. Also determine the number of shares if the company decides to issue shares in multiples of rupees 50 only. So, calculate the number of shares. How many shares to be issued? See, 2,50,000 is the face value. How much of divisible profit is available? 150. So, 1 lakh is the number of shares to be issued. Sorry, not number of shares. 1 lakh is the face value of shares to be issued. Now, here, what is the face value? 9. So, 1 lakh divided by 9 if you do, it becomes 1,111.1, or you round it off to 11112. So, these are the number of shares that are to be issued, right. So, these are number of shares that are to be issued to ensure that minimum number of shares are issued for the purpose of redemption. Then, also determine the number of shares if the company decides to issue shares in multiples of rupees 50. It is not multiple of rupees 50, it is multiple of 50. So, if you have to it has to be in multiple of 50, then it has to be 11150 if you do it in multiples of 50. Okay. Right. So simple question again. Then, Make Limited had 6,014% redeemable preference shares of 100 each fully paid up. The company had to redeem these at a premium of 10%. So, 6,000 into 100, 6 lakhs, premium of 10%. So, 60,000 premium, which is 6,60,000. Please remember, this premium has to be provided out of your P&L account. Okay. It was decided by the company to issue the following: 50,000 equity shares of 10. So, 5 lakhs face value here. 2,012% debentures of 100. This is not relevant for CRR. The issue was fully subscribed and all amounts were received in full. The payment was duly made. The company had sufficient profit. So, journal entries in the books of the company. Now, how much will you transfer to CRR? 6 lakhs minus 5 lakh. 1 lakh has to be transferred to CRR. Apart from this, there is no complexity in the question. You just calculate this CRR and transfer it to CRR, and this 60,000 has to be provided out of P&L. That's it. Okay. So, what are the journal entries? Let's have a look at it. Issue of shares 5 lakh, issue of debentures 2 lakhs, P&L to capital redemption 1 lakh, premium on redemption 60,000, P&L to premium on redemption 60,000, and of course, the redemption related entry. Then, Alpha Limited, a listed company, issued 3 lakhs 5% debentures on 30th of September of year 0, on which interest is payable half yearly on 31st of March and 30th of September. The company has power to purchase the debentures in the open market for cancellation. The following purchases were made during the year ended 31st December and the cancellation were made on the same date. On December of year 0, investments had been made for purpose of redemption were 45,000. So, this is the 31st December, what the investments they have made. They purchased on 1st of March 50,000 nominal value, purchased for 49,450 x interest. 1st September year 2, 40,000 nominal value, 4250 come interest. You are required to draw up the following accounts for the year ended 31st December of year 2: debentures account and own debentures investment account. Ignore taxation, interest to be rounded off to the nearest rupee on the higher side. So, here they have said whatever is the interest, round it up to the nearest rupee on the higher side. So, take the higher number and calculate the interest to the next highest number. Now, here what are you required to do? You are required to draw up the account for year ended 31st December of year 2, and they have said on 31st December of year 0. So, we do not have the information for year 1. Okay, that information is not there, and also we are required only debentures account and own debentures account. So, we are not required to prepare the investment account, right. So, you have to prepare debentures and own debentures for which period? Year 2. That is what you are required to do. What is the opening balance? Opening balance is 3 lakhs. Opening balance is 3 lakhs. What is the purchase? 1st of March, 50,000 nominal value, 49,450 x interest. How much is the interest here? Interest will be 50,000 multiplied by, what is the rate? 5%, 5 by 100 multiplied by purchased on March, right. When is the interest paid? 30th of September. When is the interest paid? 31st of March and 30th of September. So, from September, October, November, December, January, February, 5 months of interest into 5 out of 12. That is the first calculation. Then 40,000 nominal value purchased for 4250. Here it will be 40,000 into 5% into again 5 out of 12 because it's on 1st of September, right? If it was on 30th of September, 6 months would have been completed. So on 1st of September, 5 months completed. This is the interest. Now here it is X interest. So you will pay 49,450 towards debenture. Interest whatever is calculated is towards interest paid separately. 4250 come interest. From this you will reduce the interest and calculate what is the amount paid to the debenture. So that is it. You have to do nothing complicated again. So let's see the solution. 50,000 into 5% into 5 by 12, 1042. So 1042 is the interest paid. Now when you prepare the own debentures investment account on 1st of March to bank, nominal value 50, 49,450 is towards the debenture and 1042 is towards the interest. And on 1st of September, you paid how much? You paid 4250. This 4250 includes interest. So what you will do? You will reduce the interest. 4250 minus 834, 39,416 is the amount that you will consider towards the cost. Now this balances, which is 49,450 here and 39,416 here, that will be transferred to the debentures account because you will cancel on the same day. So by debentures 49,450, by debentures 39,416. What about this interest paid? That will be transferred to the P&L 1876. Right. Now coming to debentures account, balance is 3 lakhs. Cancelled 49,450. What is the nominal value? Nominal value is 50. You paid only 49,450. So whatever is the cancellation, that is the profit on cancellation 550. Similarly, next 39,416, 40 minus 39,416, 584 is the profit on cancellation and 2,10,000 is the balancing amount which will be carried forward, right. Then the next one on investment account, Remo Limited held on 1st of April year 2021, 1009% government securities at 90,000, face value is 100. So this is the cost, 10,000 into 100, 1 lakh is the face value. So face value is 1 lakh. 3 months interest had accrued on the above date. So on 1st of April, 3 months interest are accrued. On 1st of May, the company purchased the same government securities of the face value of 80,000 at 95 come interest. Now how do we understand this? 80,000 at 95 means at 95%. So 80,000 into 95% is 76,000. Now the 76,000 includes interest. How much is the interest? Interest is 80,000 into 9% multiplied by, when did we purchase? We purchased on 1st of May. Now as on 1st of April, 3 months interest have accrued. So on 1st of May, 4 months interest would have accrued. So 4 by 12, that would be 80,000 into 9% into 4 divided by 12, it is 2,400. So X interest price is 76 minus 2,400, 74, 73, 600 is the X interest price, right. So if you come to the solution, balance brought on face value 1 lakh, cost 90,000 and why interest? 3 months interest is accrued on this 1 lakh. So that is provided. Then to bank account, whatever is the purchase, 80,000 is your face value, 2,400 is paid towards interest and 73,600 is the value that we have calculated towards the cost of the, cost of the government securities. Then on 1st of June, 60,000 face value of the security was sold at 94 come interest. How much? 60,000 face value. So 60,000 face value multiplied by 9% multiplied by, when was it sold? 1st of June. On 1st of April, 3 months interest is accrued. On 1st of May, 4 months. On 1st of June is when we have sold, 5 months. So 5 out of 12. 9 6 are 54. 54 into 5 by 12, 5,400 into 5 divided by 12, you get 2250. So in the sale side, what you will do is by bank, interest column 2250 and they have sold at 94. So sale value is 60,000 into 94, that is equal to 56,400 minus 2250. Minus 2250, you get 54150. So, this 54150 you will credit in the cost column, and 2250 you will credit on the interest column, face value 60,000, right. Then interest on the security was paid each year on 30th of June and 31st of December and was credited to the bank account on the same date. Now, how much interest will we receive? Okay, for that, the opening balance is how much? 1000 into 90,000 face. Opening balance is 1000, face value 100, 1 lakh, plus purchased 80,000 face value, sold 60,000 face value. So, 1 lakh plus 80 minus 60, 120. 1 lakh 20 into 9% by 2, you get 1 lakh 20 into 9% is 10,800, half yearly makes it 5,400. This is the interest that is received. So, here you can see 5,400 interest which is received, right. Then, one thing what you have forgotten is when we sold on 1st of June, 60,000 face value of security was sold for 94. How much should be the profit? That has to be transferred. Now, what they have said, FIFO method should be followed. FIFO method should be followed, meaning to say, on 1st of June when we have sold, what is the FIFO? We have sold on 1st of June, means this has been sold out of this opening balance. What is the cost? 90,000 is the cost, right. So, profit on sale, face value sold is 60,000, cost is how much? 90,000, so 90%. Cost is equal to 60,000 into 90 divided by 100, that is 54,000. How much have we realized? So, this is the working. Face value sold 60,000, cost is 60,000 multiplied by 90 by 100, because for 100 face value 90 is the cost, 54,000 is the cost. Sale value 54,150. Sale value 54,150. So, profit is 150. So, that profit you will transfer to the P&L, right. Then, moving on 30th of September, 40,000 face value of government securities were sold at 97 come interest. So, now here again you have to calculate how much is the interest, which is nothing but 40,000 into 9% into how many months? When did we sell? 30th of September. Interest is paid on 30th of June. So, July, August, September, 3 out of 12. Okay. So, 3 out of 12 is 3 4s are 12, 4 into 10,000, 10,000 into 9%, this is 900. So, 900 is the interest component, and the balance amount that you have received, how much have we sold it for? 97%. Now, what is the face value? 40,000, sold at 97%. So, 38,800. Out of this 38,800, 900 is interest. So, 37,900 is the principal amount or the investment amount. So, 37,900 you credit here. Now, how much is the P&L? Again FIFO basis. So, out of this 1 lakh, 60,000 is sold here in this case, and balance 40,000 is sold here. What is the cost of this 40,000? So, again 40,000 into 90, 36,000 is the cost, 1900 is the P&L. On 1st of December, the company purchased the same security for 10,000 at par x interest. So, that is directly a purchased entry, 10,000 at par x interest means you have to add the interest. So, now you can calculate the interest and add it, a simple thing. On 1st of March, the company sold 10,000 face value of the government securities at 95 x interest. Again, now they have sold 10,000. Now, from where will we get this? See, this 1 lakh here is exhausted here 60,000 and 40,000. Then the next 10,000 that is sold. Then the next 10,000 that is sold is from this 80,000 lot. Okay, this 80,000 was purchased at 95 come interest. We had calculated the x interest also. So, from here you can calculate the x interest cost, which is 73,600 divided by 80,000 into 100. If you do 73,600 divided by 80,000 into 100, if you do, you get 92. So, cost is 92, selling price is 95. So, 3 is your profit. Okay. How much have we sold? We have sold face value 10,000. So, that is We have sold face value 10,000, that is 100. So 100 into 3, you get 300. Another way to do is cost of 10,000 face value is equal to 10,000 divided by 80,000 into 73,600. So this will give you the cost, and then you can compare with the proceeds and calculate the profit, which we have also calculated at 300. And what is the balance carried on? Again, FIFO method, 70,000 from here and 10,000 from here. That is the balance carried down. And interest, whatever is accrued till date, you will provide for that, which comes out to 1800. Okay. So how do we calculate the interest? 80,000 into 9% into, we are in March, 31st March. So April, May, June, 3 by 12. So 80,000 into 9% into 3 divided by 12, you get 1800. That is the accrued interest to be carried on. And whatever is the balancing figure on the interest side, which is 9525, that will be taken to P&L. Okay, so this kind of questions actually needs a lot of patience in working terms. Okay, same thing again, multiple numbers and all of that. But if you do everything right, 10 to 12 marks is in your pocket straightforward. Let's look at the next one. This is on insurance claim for loss of stock. Very simple question actually. A fire occurred in the premises of Star and Sons on 21st of March. The concerned had taken an insurance policy of 75,000 which was subject to average clause. From the books of accounts, the following particulars are available relating to the period from 1st of April to March 21st of 2022. Okay. Stock, opening stock 150,500. Purchases, including purchases of 40,000 for which purchase invoice had not been received from suppliers, though goods have been received in the godown. So here total purchase is 317 and this includes purchases for which invoice had not been received. So we have not received the invoice, but it is already included here. Should we consider it? See, the idea is what? To calculate the stock. Is the stock inside the godown? Yes, the stock is inside the godown. So this 40,000 will be considered and will be included in 317. Then cost of goods distributed as samples for advertising from 1st of April to the date of fire included in above purchases 32,000. This you will reduce because this you have given it for free. You will take it as an advertisement expenses in the P&L. Then sales excluding goods sold on approval basis having sale value of 35,000. So sales 455. This does not include goods sold on approval basis. But now that consignment is out. Consignment is not in the godown. So these have a sale value of 35,000. So you will add it to this 4,55,000. Purchase return 15,000. You reduce from here. Wages including salary of manager 10,000, 65,000. Average rate of gross profit 20% on sales. That is given, and cost of goods salvage is 12,000. You are required to calculate the amount of claim. So very simple, prepare a memorandum trading account, take the opening stock, take the purchases, sales, adjust expenses, gross profit, and whatever is the balancing figure will be your closing stock. So let's have a look at it. Alright, opening stock 150,500, this is given in the question. Purchases 317 minus purchase return 15,000 minus 32,000. So that is what they have done. Wages 55,000, sir. Why 55? Because this manager has been given 10,000 salaries. You will only take the direct wages, which is factory wages 55,000. Then gross profit 20% on sales. Now which 20% on sales? See, 455 is this sales plus 35,000 also you will take it as sales. Sir, why do we take it as sales? Because the goods have moved out. Notionally think that you have sold the goods. And because these goods would not have been destroyed by fire. So 455 plus 35, you have 490. On this 490, 20%, if you calculate, it comes to 98,000. And the closing stock is the balancing figure, which is 83,500. Right. Now, they have taken an insurance policy of how much? 75. How much is the stock in godown? 83,500. Right. So there is a case of under insurance, and accordingly you will apply the cost. Right. Now, how do we calculate this? Stock destroyed 83,500, salvaged 12, loss of stock 71,500, and insured value divided by total cost multiplied by the loss, you will get the insurance claim. Very, very simple. Easily 8 to 10 marks is in your pocket here. Right? 8 to 10 marks. Easy calculations, not to worry. Then the next one, hire purchase transactions. The following particulars relate to hire purchase transactions. Number 1. Hire purchaser purchased 3 machineries from S on hire purchase system, the cash price of each machinery being 3 lakhs. So, cash price is 3 lakhs, number of machine purchased is 3. The hire purchaser charged depreciation 20% on WDV method. So, from this every year minus 20%. 2 machineries were seized by the hire vendor when second installment was not paid at the end of the second year. The hire vendor valued the 2 machines at cash price less 30% depreciation charge for each year under WDV method. So, what they did, 3 lakhs was the cash price. So, there are 2 things, 3 lakhs was the cash price minus 20% first year 60,000. So, you get 2,40,000 minus 20% second year 48,000. So, you get 0, 0, 0, then 10 minus 8 is 2, right, and 23 minus 4 is 1,92,000 per machine. This is in the books of purchaser. The vendor is saying, I'll repossess them at 3 lakhs minus 30%, so 90,000, which brings you to 2,10,000 minus 30%, 63,000. So, 210 minus 63,000 is 150, 147,000. This is the repossessed value per machine. 2 machines have been repossessed here, and here this is for each machine. Okay. Then the wire vendor spent 15,000 on repairs of the machines and sold them for a total amount of 255. So, he repossessed 147 into 2 machines were repossessed and spent 15,000 on repair. So, that will add to the cost and sold them for a total amount of 255. So, you will calculate the profit or loss. Calculate the agreed value of 2 machineries taken by the hire vendor, 147 into 2. Book value of 1 machine left with the hire purchaser, 1,92,000. Profit or loss to the hire purchaser on 2 machineries taken back. Profit or loss on machinery repossessed when sold by the hire vendor. Now, what is the loss to the hire purchaser on the 2 machines taken back? See. Book value is equal to 192 into 2. So, 19 to 38, 3,84,000. Agreed value is 147 into 2, 147,000 into 2, 14 to 28, 28 plus 14 is 294. So, 90,000 is the loss, right. So, let us see whether we calculated it quickly and correctly or not. Agreed value 294, calculated here. Then book value of 1 machine 192, book value of 2 machines 384, value at which taken back 294, loss to the purchaser 90,000, calculated here. Then profit on loss on machine, so sale proceeds 255, value at which machine were taken back 294, repairs 15, so 309, loss on resale 54,000, straightforward. No entries, nothing required. Again, an easy question for about 10 marks. Right. Then let's move to the next one, which is departmental accounting. The following balances were extracted from the books of Beta. You are required to prepare departmental trading account and general P&L for the year ended 31st December of 22. Particulars: Department A, Department B. Opening stock, purchases, sales 3, 240, 39, 54, 60, 60, 90. General expenses incurred for both the departments were 750, and you are also supplied with the following information. Number 1, closing stock of department A 6 lakhs, including goods from department B for 120 at cost to department A. So, closing stock, this one, department A, for department A includes goods from department B for 120 at cost of department A. So, this is at what? Cost to department A, that is invoice price of department B. So, basically B gives goods to A. Closing stock of department B 12 lakhs, including goods from department A for 1,80,000 at cost to department B. So, A also gives goods to B. Opening stock of department A and department B include goods of the value 60 and 90 taken from department B and department A respectively at cost to the transferee department. Gross profit is uniform from year to year. So, gross profit is uniform from year to year. So, you have to calculate the gross profit, and then you will have to calculate what is the reserve that has to be eliminated when you prepare the departmental P&L accounts. So, now here Opening stock 3 lakhs 240, 39 554 60, sales 60 90, closing stock 6 and 12. So what you have to do is you have to prepare opening stock, take purchases, take sales, take closing stock, calculate gross profit. Okay, very simple, very straightforward. For each department you will do that, right? Now you will get some gross profit. This gross profit divided by sales, this will give you something called as GP ratio. Sir, why do we need GP ratio? To calculate the loading in the opening and the closing stock, or to calculate the reserve in the opening and the closing stock, right? Now if you see the P&L trading account for the department, opening stock 3 lakhs 2 lakh 40, this comes from the question, 3 lakhs 2 lakh 40, purchases 39 54 60, total purchases including the purchases from other departments. Then sales 60 90, sales 60 90, so 60 is the sales, 90 is the sales, right? Now using this information, profit is how much? 24 and 45. Now what is the percentage of profit? 24 lakhs divided by 60 for A, 24 lakhs divided by 60 for A, and 45 divided by 90 lakhs for B. So 24 by 60 is how much? 40%. 45 by 90 is how much? 50%. This is on the sale value. Okay. Now closing stock of department A 6 lakhs including goods from department B for 120 at cost to department A. Can I say this is 120 at selling price of department B? Yes. So 120, if it is selling price for department B, what is the reserve? So the reserve here will be closing stock in department A is how much? 120. This is at selling price of B, so 50%, that is 60,000 is the closing reserve. Then same way, closing stock of department B 12 lakhs including goods from department A at 1 lakh 80 at cost to department B. So this 180 is selling price. So 180 is selling price, 40% if I apply, I get 72,000, right? So this is the stock reserve, closing stock reserve. Same way opening reserves. Opening stock of department A and department B include goods of the value 60 and 90 taken from department B and department A respectively at cost to the transferee departments, means at selling price. So opening stock of department A includes 60 from B. So here stock reserve is 30,000. Similarly 90,000 came from A, 40%, 36,000. So this is the opening stock reserve, right? So now what you will do is those stock reserves you will plot here. See, opening stock reserve 30 and 36, 30 and 36 that we calculated. Closing stock reserve 60 and 72, 60 and 72 that we calculated, right? Then general expenses 7,50,000 that is given in the question, right? And whatever profit you calculate from each of the department, 24 lakhs and 45 lakhs, you will transfer to the general P&L 24 and 45. And after deducting the general expenses, you will arrive at the net profit. So very simple. Then the next one is on branches. PQR has a branch at Houston, USA. Business of the branch is carried out substantially independent by way of accumulating cash and other monetary items, incurring expenses, generating income and arranging borrowing in its local currency. So is it an integral foreign operation? No, it is a non-integral foreign operation. The trial balance of the branch is given below. Office equipment at cost, accumulated depreciation. Furniture fixture, accumulated depreciation. Opening stock 24,500. Purchases, sales, salaries, carriage inward, rent, trade receivables, payables, cash at bank, cash in hand, head office account 37,322. Following information are given. Salaries outstanding as on 31st of March of 22 is $600. Depreciate office equipment at 10% at return on value. So you will take this return on value and then you will calculate. Closing stock is 24,650. You are informed that the head office is showing receivable from branch as 23,75,614 as on 31st March. No transaction in respect of branch is pending at head office. So this will be the closing balance. Office equipment cost includes one office equipment of 2,400 purchased on 1/4/21. So for this you will not charge full year depreciation. One furniture carrying value of $450 on 1st of April cost US $500 and accumulated depreciation $50 has been sold for US 405 on 31st March 22 to Mr. M at no profit, no loss. Mr. M has not paid the amount till date, till the finalization of branch. No entry has been passed for the sale of furniture in the above trial balance. So, this entry is pending. The rate of exchange for different dates are given below. 1st of April 64 opening, 31st of December 70, 31st of March 75, average 72. You are required to prepare the trial balance after incorporating the adjustment given and converting US dollar into rupees. Right. So, what you have to do? Update the trial balance and prepare it and convert and translate that into rupees. Now, here as far as the question is concerned, we are required to prepare trial balance after incorporating the adjustments that are given. So, basically what you have to do, salaries outstanding, what will you do? You will add it to salaries and you will add it to outstanding salaries. Then depreciate office equipment and furniture at 10%. So, whatever is the information given, office equipment and furniture, you have to depreciate at 10%. Please remember, office equipment at cost includes one office equipment of 2400 purchased on 1st April of 21. So, when are we preparing this for? 31st March of 22. So, this number office equipment at cost includes that number also, but anyways because it is purchased on 1st of April of 21, it does not matter. So, what you will do is 56,400 minus 5,400, which is 551,000. On this office equipment you will provide depreciation at 10%. So, 51,000 into 10%, you have 5,100, right? That is the depreciation. Then coming to furniture and fixtures, cost is 36,000. Opening accumulated depreciation is 6840. Then there is a transaction which said one furniture of carrying value 450 on 1st April, cost of 500, accumulated depreciation 50 has been sold for 405 on 31st of March to Mr. M at no profit, no loss. So, now what has happened here is, please look at this very carefully. 36,000 is the cost, 6840 is the accumulated depreciation, that is the total part. Now, one item costing 500, carrying value 450. So, item costing 500 and having depreciation of 50, cost, accumulated depreciation, net value 450. This is sold on 31st March of year 2, means what? Another depreciation. So, this is 450, then depreciation of 45 will be provided, right. So, now it is be 400 minus 95, that is equal to 405. So, 405 has to be eliminated from your furniture and fixtures and accumulated depreciation on a net basis. So, what you will do is 36,000 minus 500, you have 35,500. Depreciation, if you see, is 6840, right. Now, on this 36,000 minus 6840, how much is this? 0, 6, 1 and 160, and 35 minus 6 is 29, 2916. 2916 into 10% is 2916. This is your depreciation. Okay. This 2916 of depreciation includes this 45 of depreciation. So, what happens is, to 6840 you will add 2916 of depreciation and you will reduce how much? 50 and 45 which is sold, minus 95. So, 6840 plus 2916 minus 95, if you do, you get 9661 of accumulated depreciation, right. So, this is your depreciation number accumulated, this is your carrying amount. So, if we come back, so if you see the solution, office equipment 56,400 is the total cost, accumulated depreciation 5400 plus 5100. So, 5400 plus 5100 that we have calculated here, 5400 minus plus 5100. Then Furniture and fixtures. Furniture and fixtures, if you see, 36 minus 500, 35, 500, 35, 500. Accumulated depreciation, 9661, 9661, right. All these will be converted using the closing rate because it's a NIFO. Then, what is the total depreciation? Total depreciation is 5100 plus, where did I calculate that? 2916. So, 5100 plus 2916, you get 8016 at 75 you will convert. Now, also remember, when we sold this at 405, there is a receivable which has to be created, which will also be added. Okay, so you will have to add an item of receivable. Here they have said Mr. M receivable 405. Okay, then closing stock, you take this number multiplied by the closing rate 75, be done with it. Then head office is showing receivable from the branch as 2375,614. So when you prepare the balance, you will take 2375,614 as it is. Then office equipment we have already taken care. Furniture carrying value we have already taken care. Then rates, 1st of April, when will this rate be important? For opening stock. Then 31st March year 2 closing rate for the closing items balance sheet. Average for the year 72 for your P&L items, right. Now, I don't know why did they give for December 31st, is there the balance? Nothing is there. So, they have just given it for 31st December, that is not relevant for us, right. So, now if you see the conversion, very simple, office equipment depreciation 75, then opening rate, purchases. Now, all of these will take average rate because these are transactions throughout the period. So, purchases, sales, carriage inward, salaries, rent rates and taxes, salaries payable. Now, one thing you have to understand is salaries you have taken average rate because it's a transaction throughout the period. Closing balance of salary you will take 75. Head office you will take at actuals, other items you will take at closing rates, and whatever is the difference that will be parked in the exchange gain account. Very simple, just that these few adjustments might sound complicated, but otherwise it will be easy to handle. Then accounts from incomplete records. The following information relates to the business of ABC Enterprise, who request you to prepare trading P&L for the year ended 31st March 22 and the balance sheet. Assets and liabilities, opening and closing are given. Furniture, stock, sundry debtors, question mark, you have to calculate. Creditors, prepaid expenses, outstanding expenses, cash in bank. Cash transaction during the period. Collection from debtors after allowing discount of 15,000 amounted to 58,500. So, 5,85,000 and 15,000 is the discount. Okay. So, these two are the amounts you will post it to the credit of the debtors account. Collection on discounting of bill of exchange after deducting discount of 1250 by bank, total 61,250. So, this is the bill of exchange. Creditors 4 lakhs were paid 392. So, this is again including discount. Similar question is there in the material also. Payment of freight 30,000. Amount withdrawn for personal use, this is drawings. Payment for office furniture 10,000 added to furniture. Investment carrying annual interest of 6% were purchased at 95, 200 shares, face value of 100 each on 1st of October and payment made thereof. So, they have annual interest of 6%. When did we purchase? 1st of October, 6 months interest needs to be provided. Purchased at 95. So, 20,000 into 95, that is 19,000 is the payment amount. Then expense includes salaries paid 95,000, expenses including total expense, miscellaneous receipt 5,000. Then bill of exchange drawn on and accepted by customers during the year amounted to 1 lakh. Of these bill of exchange 20,000 were endorsed in favor of creditors, and endorsed bill of exchange 4,000 was dishonored. Now please remember, when you have bill of exchange, first you start with bill of exchange. Then you come to the debtors and creditors account. Goods costing 9,000 were used as advertising material. So, this you will reduce from trading and you will debit it to P&L. Goods are invariably sold at to show a gross profit of 20% on sale. So, whatever is the GP, that is 20% on sales, right. Differences in cash book, if any, is to be treated as further drawing on introduction of capital by proprietor. So, if there is any shortfall, you will say, okay, it's a drawing. If there is any, if there is any shortfall, means the proprietor has introduced capital, and if there is any excess, now when you prepare the cash book, if you find any shortfall, that shortfall you will assume that the proprietor has given you as a capital contribution. If there is excess in the balance, then that excess balance is assumed to have been withdrawn by the proprietor. Provide 2% for doubtful debts and closing debtors. Now, the most important thing here is they have not given us what is the total sales. That has to be derived from by preparing the debtors account. Okay. Now here debtors also closing balance is not given. Now if they have not given closing balance, then how will you calculate? Then you have to look at, you have stock, you have creditors. From the creditors account, can you calculate the purchases, because you have creditors and you have payment made to creditors. From there you calculate purchases, from there you calculate cost of goods sold, from there you calculate the total sales. So that is the roundabout what you have to do to arrive at the numbers in these kind of questions. So now what we will do, we will prepare the creditors account. For creditors account, do we have the information? So creditors account, we have the closing balance, we have the opening balance, we have payment made, creditors of 4 lakh were paid in 392 full settlement, then we also have endorsement of bill and then bill dishonored. So multiple things. Creditors account, if you prepare, you have opening balance, you have closing balance, you have payments, you have bills endorsed, you have bills dishonored, right? Then apart from that there is also discount. So discount also will come on this side, and then the balancing figure whatever you have, you will get the purchases, right? So let us see. Sundry creditors account, balance brought down given in the question, balance carried down given in the question, amount paid 392 given in the question, discount 8000 given in the question, bills receivable that we have endorsed, so you will debit the creditors and credit bills receivable 20,000, bills, then bills was dishonored, so you will reverse the entry. When there is a dishonor of the bill, you will debit the debtor and credit the creditor, because that bill receivable because the bills receivable does not have any more existence. You have to collect the amount from the debtor and pay it to the creditor, so that is what is added 4,000, and the purchases becomes your balancing figure, which is 4,56,000. Now, do I have opening stock? Yes. Do I have purchases? Yes. Do I have closing stock? Yes. Can I calculate the gross profit? Gross profit is given on sales, but I can calculate gross profit on cost also. Now here please remember, out of this purchase, some amount has been given as advertisement, so that you will reduce from the purchases, okay. And a lot of you struggle, if they are given 20% on sales, how do we calculate on the cost? Okay. So now, if sales are 100, always whatever is the percentage given on that amount, take that as 100. If sales are 100, profit is how much? 20, cost is 80. Now once I know the cost, if cost is 100, profit will be how much? Do a simple cross multiplication. So 100 into 20 by 80, 0024, 25. So 25% is your profit. Now here we will calculate cost of goods sold. So let us calculate the cost of goods sold. Opening inventory plus purchases minus closing stock, and yes, there is freight also, right? So in the question they have mentioned freight inward is also there, so that also you need to add. So if you add freight inwards minus closing inventory, you get the cost of goods sold, and on that if you add the gross profit, you will get the total sales, which is 6,08,750, right? So now the sales, you will use it to prepare the trading account, right? Or if you don't want to prepare a working note, here only you can calculate the sales. Here only you can calculate the sales, because you have opening inventory, you have purchases net, freight inwards is given, closing inventory you have, gross profit, you have to prepare a working note. How much is gross profit? We calculated 25. So gross profit is 25% of cost. Using that, you can calculate the gross profit and arrive at sales. Now this sales, you will post it to the debtors account. Now even for that, first you will prepare the bill of exchange account. Bill of exchange account. In the bill of exchange account, you have the bills which have been received from the debtors given in the question 1 lakh, discounted, endorsed to creditors 20,000, discounted with bank. So if you come back to the question, they say after deducting discount of 1250, 61250 has been received. So 61250 is credited and 1250 is transferred to the discount account. So 61250 and 1250, balance carried down is the balancing figure 17500, right? Then from the bills receivable account, you will prepare the debtors account. The reason why I asked you to prepare bills receivable first, because sometimes there may be cases where you may get a hidden information from the bills receivable account. Okay. So sundry debtors, balance brought down 160 given in the question. Cash and bank account amount received, discount 15,000 given in the question. Bills receivable received 1 lakh. Dishonored from sundry creditors account, balance carried down, balancing figure 72750, right? Then you have to prepare the cash and bank account, which is balance brought down is given. Sundry debtors 585, information from the question. Bills receivable, from that we have got 61,250. Miscellaneous income given in the question. Freight inwards given in the question. Furniture purchases given in the question. Investment 19,000 we calculated. Other expenses 95,000 in the question. Creditors we have paid 392. And drawings account, what happens is, if you come back, they say amount withdrawn 70,000. And if you plot 70,000 here and take the closing balance, there is a difference of 21,000. That 21,000 is also assumed to have been withdrawn. Okay. Then with this we can head to P&L account and also the balance sheet. For the balance sheet, you have to prepare opening balance sheet. Information is there in the question. Using that you can prepare. So let us come to the P&L. So trading part we have already discussed. Sundry expenses. Now what are these sundry expenses? Now what are these sundry expenses? If you go back to the question, it says expenses including salary paid 95,000. Salaries paid 95,000. So 95,000 is the expense. Now out of this 95,000, opening prepaid and closing prepaid are there. Means previous year there is a prepaid 6,000. This you will add, minus current prepaid 7,000 you will reduce. Then outstanding expenses, previous period outstanding expenses, and here they say cash transaction includes expenses, means this 95,000 includes payment. Then if you have opening outstanding which is pertaining to previous period expense, that you will reduce from this number. Current year outstanding plus 18,000 you will add. So 95 plus 6 101, minus 7 minus 7 94, then minus 2 92,000. So 92,000 is the expense for the period. That is this number. This you can calculate by preparing a combined account expense account as well, including opening outstanding, closing outstanding, opening prepaid and closing prepaid as well, that we have already discussed, right? Discussed in the class. So 92,000. Then advertisement 9,000 given in the question. Discount, debtors we have allowed 15 and bill receivable 1250. Depreciation on furniture 6,500. So what is the question says on depreciation? Payment for office furniture is 10,000. Then the opening balance is 60, 63,500 is the closing balance. So 60 plus 10, 70. Closing balance is 63,500, means what? 6,500 is your depreciation, right? So that is the amount of depreciation, 6,500. Provision for doubtful debts 2% given in the question. Then interest on investment purchased halfway through the year on 1st of October. So 6 months interest is accrued here. Discount received 8,000 and other income 5,000. You will get the net profit. And with that, you can easily calculate the balance, the balance sheet, prepare the balance sheet. Furniture 63,500. You have the, breakup, opening, purchases and depreciation. Investment from the information in the question. Interest accrued on investment. Closing inventory as per the information in the question. Sundry debtors, again, the information is there. Bills receivable we have calculated. Cash in hand and cash at bank, it's already there. Prepaid expenses, it's given in the question. Capital less drawings plus profit, closing balance, sundry creditors and outstanding expenses, right? So once you have figured out how to handle these cash transactions and related adjustment, preparing P&L and balance sheet will not be a challenge. Only challenge here would have been that the sales number was not given. Because sales number was not given, you have to calculate cost. Cost is nothing but opening stock plus purchases minus closing stock plus if at all there is any direct expense, right? Get the cost, calculate the profit and arrive at the sales value, right? So this covers the part which is other than accounting standard. In the next part we will cover framework and we will also cover the accounting standard related questions.